Should you invest all your money at once or slowly through SIP? That's where lump sum investment comes in. Hi everyone, welcome to Seeds of Finance, and in today's video, let's understand what lump sum investment is, how it works, and when it is suitable for you to invest. Let's begin. Lump sum investment means investing a large amount at one time in a mutual fund. Unlike SIP, where you invest regularly, in lump sum you invest once or in fewer installments. When you invest a lump sum, your entire money is invested at the current NAV. Units are allotted based on that NAV. Returns depend on market movement after investment. For example, if NAV is Rs 50 and you invest Rs 1 lakh, you get 2000 units. Lump sum investment is useful when you have surplus money like bonus, inheritance, and sale proceeds. Markets are reasonably valued and you have a long-term horizon. It allows your money to benefit from compounding immediately. The biggest risk is market timing. If you invest just before a market fall, returns may suffer in the short term. That's why lump sum investments require higher risk tolerance and longer holding period. Here's a quick comparison between SIP and lump sum. SIP is of lower risk, disciplined, and ideal for beginners, while lump sum is of higher risk and suitable when market conditions are favorable. Many investors use both strategies together. Lump sum investing works best when you have surplus money and patience. In the next video, we'll understand units in mutual funds. Subscribe for more finance related videos. Thanks for watching.